Welcome back to TapHere, where money and technology talk, and we're certainly going to talk quite a bit about money and technology today with Noah Solomon. He is the Chief Investment Officer, CIO of Outcome Metric Asset Management. Based in Toronto, Outcome's been around for a while, and their focus has constantly been and has always been on algorithms, data, artificial intelligence, and machine learning to make investment decisions. And with everything that's going on with AI and how popular it's become, and the question, of course, whether machines are going to take over in terms of investing, Noah's going to give us his take. Noah, thank you very much for joining us today. I am super excited to dig into all things AI, technology. Of course, none of this is really all that new for you. It's just probably a very long-standing evolution. But I really want to hear more about sort of Outcome and how basically AI and technology and modeling applies to investment. So let's start there.
Well, thank you for having me, first of all. And I don't know if I know all things AI, but I can certainly talk more intelligently about how we apply it or how it gets applied or can be applied to investing. So, like most things in life, I came to it in a roundabout way. I never had a master plan to design or manage algorithmically driven investment strategies. Not when I was 8, not when I was 12, not when I was 22.
Okay.
So I came about it in a funny way. There were two things that really struck me. Well, number one, I really like statistics. I really like statistics and probability and relationships between variables, which is really the basis of a lot of this, which I'll get into later. But I remember in graduate school, I went to the Wharton School of Business, and there were two things that caught my attention, or a few things. Number one, I remember I had this course, and they gave us a random sampling of, I think it was US mutual funds. ETFs really hadn't taken off to the same degree yet. So they gave us a large sample of mutual funds and a time series of their monthly returns going back, a decade or so. And then they had the same thing for the S&P 500 index. Mm-hmm. And they basically challenged us to find a mutual fund that added value, that outperformed either in absolute terms or on a risk-adjusted basis.
And not to date you, but how far back are we talking here?
This would have been 2000, 2001.
Okay, all right.
Couldn't find one. So I go, that's interesting. And as I said, I liked statistics, and I thought there must be a different way. There must be some way of looking at data to ascertain relation. There must be a better way that is unemotional, that is data-driven, that is empirical, that is logical to go about investing, to constructing portfolios. Mm-hmm. And I didn't really have any idea whether it should be applied to stocks or asset allocation or all of the above, but it was just a very, blue sky idea. So I started, they had access to all the data you could want.
Right.
So I started plugging away at it then, so that's sort of how I came to it.
Okay.
Or first came to it. And then when I graduated and I went to work for Goldman Sachs, that's when I started implementing some of these things. And it's funny, you had mentioned this earlier, about AI. So at least as it applies to investing, what they call AI today has been around for a long time. Mm-hmm. They just didn't call it that. It had different, terms that, quantitative investing, statistical arbitrage, systematic investing. They didn't call it AI. But that's effectively what it was. The only difference today, it's the same from 10,000 feet. Today, obviously, the availability of different types of data is much broader, and the ability to process it, huge quantities of data in real time, is much greater than it was then. But the methodology is the same thing. At its root, AI is basically statistics and pattern recognition.
So, of course, and that's exactly what I want to talk about. I want to get into all of that because I think from your vantage point, even before Outcome, which has been around since, you tell me, it's been 2015?
Outcome 2017.
2017, right. So even looking at the technology of the last 6 to 9 months, it's changed. I mean, again, thinking from an outside perspective looking in. Everyone sees AI as like, wow, this stuff is hot. It's going to change. It's going to revolutionize how investing works. And yet I know that you and I have actually sat down before some time ago. And really, as you just pointed out, nothing has changed. So talk to us maybe a little bit about, I think at least, what you're seeing as sort of the new stuff versus the abstract old stuff.
Well, I think one thing that has changed is the awareness and perception of it. So, algorithmically driven investing, data-based strategies, they've been around in the US for a long time. And there's quite a number of firms doing it, and collectively they're managing quite a large amount of assets doing it. Canada, not so much. I remember, when I first came back from the US in 2008, and you would talk about this kind of investing, and they would look at you with some combination of fear, awe, fear, like you have two heads, you're nuts. I'm being a little facetious, but there was certainly not a broad-based awareness, and certainly not an acceptance of, and maybe even some fear, like, oh, I don't know about this. Today, that's not the case.
Right. Sorry, just to clarify, fear of what do you think they were afraid of?
Fear of something they don't understand.
Okay.
Something new. Fear of the unknown. That's the
fear of applying model statistics or something beyond.
And I still get some of this.
Okay.
I still get, well, you don't speak to management, or you're saying you don't do fundamental analysis, and no, I don't. I don't. You get a little bit of that now. But now it's more about, why don't you have some or incorporate some traditional methods into your process? Before, the conversation was, why are you doing this at all?
Which is interesting, because if you look at the environment right now, yeah, exactly. It's like, why aren't other people doing this? Why are you spending your time, your manual energy trying to pick stocks, pick securities, pick what's going to happen in the future that obviously you don't know about? Which maybe is a great segue to talk a little bit more specifically about the models, some of the stuff that you focus on. Again, we might be going out of order here, but just tell us sort of how it works from an investment process. Like, what do you when you wake up in the morning and you come here, like, what are you actually trying to accomplish within the different variances of the funds that you operate?
Well, working backwards, you're trying to get better results.
Mm-hmm.
And, back to your previous thing, you get put on the defensive. Well, what do you mean this algorithmically? And you don't speak to management, or you don't listen to the company earnings call? Well, there's a couple things I'd say about that. So what we know, this is hard, cold fact, and it's been the case for a long time, is, well over 90%, usually over 95% of active managers underperform their benchmarks. That is fact. It is incontrovertible. And by the way, I'll front run this. You say, well, maybe they don't get as high returns, but on a risk-adjusted basis. No, 95% underperform when you adjust for risk too. So
a lot of them would disagree with you. I'm just pointing that out.
That's
right?
fact.
Yeah. Okay.
So S&P Global publishes this report semi-annually for every major market, including Canada. And they call this report their semi-annual SPIVA scorecard, SPIVA, which is an acronym that stands for S&P Index versus Active.
Okay.
And in that report, they will tell you the percentage of active managers who have managed to outperform their benchmark over the last year, 3 years, 5 years, consistently. High 90s, underperform, percentage-wise.
Okay.
And it's consistent, not just in Canada, in the US, in Europe. It's consistent, it's pervasive. There's an expression I like: in God we trust, all others bring data. So anyone that says that, active management generally adds value, you're a flat earther. The data is just too pervasive, too damning, too broad, too deep. Now, I don't want to be dogmatic. To be clear, I am not saying that there are no active managers that add value, but the odds aren't good. The data is very clear and very damning.
So, and let's go there, right? I really want to sort of delve into that because I think that is,
But relatedly, when people ask me, how come you don't speak to management? How come you don't do classic traditional bottom-up fundamental analysis? So I invert it and I say, well, let's talk about what we know and then what we can assume based on what we know. So we know that well over 90% of active managers underperform their benchmark. I said, now let's assume, which I think is a fair assumption, that the majority of said managers in that database are doing so by way of traditional bottom-up stock picking fundamental analysis. I said, so therefore you're asking me to do the same thing that everyone else does that leads to over 90% of them underperforming. At that point they say, huh. And it's not that these people aren't talented. They are. But I like to say that if it's a battle between 10,000 PhDs in finance on one side and Adam Smith, the Wealth of Nations, supply and demand, he will win every time. Because in his simple model of supply and demand, he incorporates the fact that over time, they will compete each other's advantage down to zero. So the problem isn't that they're not trying to outperform, or that they're not intelligent people. The problem is that they're all trying to outperform the same way, using the same tools, which means by definition, none of them can outperform.
And yet that is the majority, or maybe it's not the majority.
You are guaranteed to underperform.
Fair, but that is certainly a large percentage of the people that are running the investment portfolios.
More than large.
And yeah,
the vast majority.
So what are we all missing?
Well, there's a couple things I'd say. Number one, there is definitely a never underestimate the power of inertia.
Okay.
Do nothing and hope nothing happens. I would say in Canada we have a structural issue, which is we have somewhat of a unique system where 95% of the wealth in this country is managed or by 6 banks. So, we learn this in Economic 101. If you have an oligopoly as opposed to a competitive environment, the public will get offered crappy product at high price. So guess what? Sometimes theory does work in practice. So there's no incentive. Necessity is the mother of invention. Given how entrenched that oligopoly is, there's no necessity, so there's no invention. You kind of get paid to show up. I could say the same for our telecom companies too, but I'm not going to go there. So a lot of it's structural. It's very entrenched. Never underestimate the power of inertia. And I think some of it's cultural, having lived in both countries. Americans, they embrace new and risk to a much greater extent than we do. They have things where I think we are much better at it than they are, but when it comes to that, they will embrace a new idea much quicker, where Canada is a little bit more of a do nothing and hope nothing happens culture. And the third reason is actually legitimately economic, which is, let's assume you had been with a manager for 20 years that had underperformed their benchmark by 2% per year. Do you know what that means with compounding? It means you've literally had half the gains you should have. But you've still made a lot of money over 20 years with compounding. A lot less than you should have or could have, but you've still made a lot of money. If you sell, you pay tax. They don't want to trigger tax. So my expression is, there by the grace of the CRA go bad managers.
So, and what I'm hearing very, very loud and clear, and rightly, is that, people have options. You are the option. You're the counter to all this, if I'm not mistaken.
It's a different way of going about things, for sure.
So, and as you point out, there are cultural differences. In some cases, there's just, sort of lack of trust. There's a lot of different factors that prevent or stop people from doing what, we might call a set it and forget it approach, which again, I realize is probably diminishing to what you do. How do you, what's your pitch? Like, how do you explain or talk to people about why they should move away from the world you just described and towards yours?
Well, I guess there's a few things I'd say, and most obvious is our results. as they say, the proof is in the eating. So we've beaten almost every other manager in that category since we started. Not just in terms of return, but also in terms of risk. I like to say we won on both sides. We've had higher returns, lower volatility, and shallower losses in challenging markets. So we've run on all the major battlefronts. We've beat pretty much everybody. So that's number one. So that gets people's attention because it is what it is.
It is what it is, but past performance do not,
no question. But it certainly gets people's attention.
Fair. Okay.
Now you've got, as they say, now you've got my attention. But the other thing we do is we explain, I guess, machine learning generally. So machine learning, AI, is generally lauded for what it can do that humans, or HI, human intelligence, cannot, which is, to summarize, the ability to gather, induct, analyze huge quantities of information very quickly or in real time and make accurate decisions that a human brain simply can't do. And that's true. Certainly that is an advantage. But what people miss is the other advantage it has, which isn't about what it has that humans don't. It's what it doesn't have that humans do, which are behavioral biases. A machine does not get up on the wrong side of the bed. It doesn't get angry. It doesn't have greed. It doesn't have fear. It doesn't have emotions. It's purely calculational and logical. And so why is that a good thing? So there's this field called behavioral economics, which has now been around for 60 or 70 years. I think the Nobel Prize has been given twice for behavioral economics. And in what it basically studies is the relationship between how we're wired, our emotions, and our financial decisions. They said it's been around for 60 or 70 years. And there are some fields where they say, well, we used to think that, but we've revised our theories. We now don't think that's the case. That's not how behavioral economics works. It has been a one-way train for 60 years. The one-way train keeps telling us again and again that when it comes to our financial decision-making, our emotions are not our friend. It is not our friend. And that has been consistent for 60 or 70 years. We're not as rational as we think we are. And the reason for that is actually quite practical. So when you think of human beings that have been around for a long time on this planet, we are endowed with certain emotions and reactive functions. We're programmed, as it were, or designed, that we needed. If we didn't have them, we wouldn't be here today. We would have gone the way of the dinosaur. A lot of that is fear, fight, flight, you're getting chased by a tiger, whatever it was. And those were very good attributes that we were endowed with in order to survive and evolve and be here today, as opposed to being extinct. However, in the modern world, particularly when it comes to financial decision-making, it is not good. And the proof is, there's this report, there's a firm in Boston called Dalbar. And they published this annual report that they call their QAIB, which stands for Quantitative Analysis of Investor Behavior. Mm-hmm. And they track many, many different mutual funds, US stock funds. And they track redemption and subscription, when people buy, when people sell these funds. The average investor in these funds has underperformed the S&P by 2 to 3% per year for the last 30 years. Now, that's not because the managers are that bad. Most of them underperform, but not nearly by that much. It's because they buy and sell at the worst times. They buy the most at the top and they buy the least at the bottom. Why? Emotions.
So, and yeah, I hear you loud and clear, and I'm thinking sort of on two planes here. One is me, the investor, my parents, whoever, saying, COVID, it's rolling across the earth. It's going to be Armageddon. Let's just sell everything and go into a basement, right? That's the investor side of it. And then there's the professional side of it where they say the same thing. Is that what you're sort of pointing to? Or is it, you know what I mean? Because I think people who hire these professionals expect them to bring in more data and utilize their analysis, their ability to overcome some of those things.
No question, I would say,
Right?
if you were a wealth advisor,
Okay.
which I am not, that's not what we do. We're fund
Me neither.
managers. But if I was the way I would put it, I agree with you. The way I would put it is a huge part of an investment advisor's role is being a psychologist or a financial psychologist. It's specifically preventing their clients, based on their emotions, from doing the exact pattern of behavior that I just described in that QAIB report. Because to protect them from themselves. And there is value in that. There's huge, as that study, the Dalbar firm shows, there is huge value in that. If you can prevent people from stabbing themselves in the eye, selling at the worst times and buying more at the best times, letting their emotions get the better of them, that has huge value over the long term.
Now looking at it from the other side, and it's funny because I'm thinking about the recent, and maybe this is it is apples and oranges, but some of the discussion around Waymo, self-driving cars, how they kind of get into accidents with themselves.
Perfect example. So I was just having this discussion, and apparently they have 10% of the accident rate of people.
Okay.
1/10.
But shouldn't it be zero?
Everything's relative. We live in a world of relativism. There's no perfection. But if you could choose something that had a 10th of the error rate, wouldn't you choose it versus the alternative? Nothing exists in a vacuum. There's no perfection. Maybe one day it will be. But back to my point about psychology, I don't know a machine. I don't trust it. But the data's there. They have 10%, 1/10 of the accident rate of people. I don't know about that thing. In God we trust, all others bring data.
Very, very true. So let's back up a little bit. Let's talk a little bit more about, obviously you've been at this a long time. You've seen different iterations and approaches. Maybe talk a little bit about how has that shifted? You mentioned obviously the volume of data, you've mentioned the ability, the speed, I'm assuming, but where have you kind of brought in new types of technology, or at least brought together what people now see and sort of said, yeah, I've been doing that for, decades.
Well, I sort of think of AI like a hammer. You can use a hammer for a lot of different things. You can use it for demolition. You can use it to punch a nail into a board. A hammer can be used in a lot of different capacities to accomplish different objectives. Within the world of investing, AI similarly can be used to achieve many different objectives. So it can be used and is used for high frequency trading, high turnover, hedge fund, levered, whatever you want to call it, high flying, institutional, family office, high net worth individual kind of stuff. Or it can also be applied to more conventional mandates like long stock investing, long-term stock investing. So there is no one AI in how it can be applied, but it can be applied in all those different milieus. In our case, we don't use it for the high flying,
Okay.
We're using it to be core in a better way. In other words, the vast majority of investors don't invest in high frequency trading hedge funds or what have you. They own stocks or stock funds, and they own bonds or bond funds. They don't turn over every day. They're not hyper trading strategies. That's what we use AI for. So we're doing the same thing as very core traditional mandates. We're just coming about it in a different way using AI. Or the way I like to say it is, we're not asking investors to do anything they don't already do. See, if you were a hedge fund or a private debt fund or a private equity fund or a venture fund, you're probably in many cases asking them to do something they don't already do.
Right.
You don't have any allocation to private debt, or here's why you should. Our message is very different. It's saying, you're already doing this. I'm not asking you to do something you don't already do. Let us just do it better.
And that's something you've been saying, I'm assuming, for quite a long time. I mean, since the foundation of Outcome, and certainly in other iterations of your career. So does it feel like, I'm not going to guess how it feels, but I'm assuming it's kind of like, wow, finally people are starting to get it.
It does. The way we came about it, specifically with our main fund, which is a dividend-focused Canadian equity fund,
Yeah.
is we saw an opportunity. So dividend-paying stocks are by far the largest category in Canada. There's an obvious reason for that because, they're taxed at a preferential rate compared to dividends from other countries.
Mm-hmm.
So it is the largest category in Canada. It doesn't get more core for Canadian investors than dividend-paying Canadian stocks.
Right.
And I mentioned that SPIVA report, and I'm going back, about 8 years before we launched our Canadian dividend or our Canadian equity income fund, but we looked at that S&P index versus active report. And it said, 95% or so underperform the TSX dividend index or the TSX dividend aristocrats
95%.
index. Yeah.
Okay.
Which is the benchmark S&P.
Yeah.
So that's not my benchmark, that's theirs.
Right.
So I'm being academically pure here.
Okay.
So we said, here's two things, on Saturday Night Live, they say things that make you go, huh. So we said, well, here's the most core category in Canada, and it seems to be a category where the vast majority of managers have struggled to add value. So maybe there's an opportunity here. Here's a space where maybe there's a tremendous opportunity. Now, we didn't know at the time whether we would be able to use our algorithms and technology to build something different and value added. You don't know until you know. As it turned out, we did. But we saw an opportunity because of those circumstances.
The flagship fund that Outcome runs, it's called the Outcome Canadian Equity Income Fund. So talk to us about that and how you approach sort of structuring and then rebalancing that and, of course, some of the other investments that you offer to the public.
So with the Canadian Equity Income Fund, what we do from a high level is we want a very basic screen where we screen companies. First of all, a few high-level structural notes. So it's done very well. It's, since its inception over 7 years ago, and again, in an environment where, according to the last report, 96.8% of managers have underperformed the TSX Dividend Aristocrats Index over the last 5 years. Since we've started, we've outperformed it by almost 2,000 basis points, 20%.
Okay. Wow.
But we've done so with considerably lower volatility and shallower losses in challenging markets. So when you combine those two features, namely what I like to say, more of the good thing, return, and less of the bad thing, volatility, our risk-adjusted returns, or some people would use Sharpe ratio, have been about 1.5 times that index, 50% higher risk-adjusted returns. So the returns have really been phenomenal. And one thing I should say is where those returns come from, where that outperformance comes from a high level. It all comes, more than 100% of our outperformance has come from what's referred to as low downside capture, which I'll explain that. So capture is a percent, and it refers to what percent of the market's move you are capturing. So if I had an upside capture of 90%, that means if the market went up 10%, on average, I'm only going to go up 9. I'm capturing 90% of that move.
Okay.
So obviously you want a high upside capture. In the good times, you want to make money, and you want a low downside capture. You want to suffer as low a percentage as possible of the losses when markets go down. More specifically, it's not one or the other, it's the ratio of the two. You want a high upside capture relative to downside capture. So I said that more than 100% of our outperformances come from low downside capture, meaning our upside capture has been about 90%. In other words, when the market goes up, we've managed to capture most, but not all of the upside, 90%. But our downside capture has been about 2/3, high 60s. So in other words, we managed consistently to capture most of the upside, but avoid a very large chunk of the downside. That's a lovely asymmetry. That's being imbalanced in a good way when you can capture 90% of the upside, but avoid a third of the downside. That's a good asymmetry. And when you can apply that kind of asymmetry to the ups and downs of markets over the last over 7 years since we started that fund, the results I describe is what you wind up with.
Now, it sounds to me, I mean, and look, don't get me wrong, but I mean, everybody, the way you describe it, of course, nobody should be using an active manager. Everybody should be relying on models, data.
I wouldn't say that.
Okay. So how does someone sort of balance or fit in, whether it's A or B, or whether there's, black or white, or like, how do you kind of decide what to let a machine run? And by the way, it also sounds like you could never actually have, if you could somehow have the individual, right, a person sitting in that chair to run what this computer and the models are doing, you would, but you can't, if I'm not mistaken.
You can't.
Right. How do you get people to kind of find that balance?
Well, the first thing I'd say, and this has nothing to do with investing, is one thing I've observed in life, and I deeply believe this, is extremes don't work. They don't work in politics. They don't work in economics. They don't work in religion. Extremes don't work. So relatedly, when it comes to investing, I would tell you, I am not the first person. I would never say, active management just doesn't work and you should never use an active manager. I would say the odds are against you based on the data, but there are some active managers that add value and have consistently for a while. It's hard to find them. They're 1 in 10 or less, or 1 in 20, but they do exist.
Mm-hmm.
So I don't want to be dogmatic about it. And relatedly, I would never say you should never do active management and only do quantitative investing. If you look at the data, people like to say, and you kind of went there a little bit, which is this kind of style of investing is good, or this style of investing is no good. Or if you actually, again, back to in God we trust, all others bring data. If you look at the data, what becomes clear is there is no good or bad style of investing.
Mm-hmm.
There's only good or bad managers within each style. Meaning, if you look at a bunch of value managers, a large sample of value managers, you'll find out there are some that are truly fantastic, and there's some that are truly horrible, and everywhere in between. If you look at growth managers, you will find some that are fantastic and some that are horrible. If you look at quantitative managers or people like what I do, systematic investors, there are some that are not very good and some that are good. And the other thing so there is no good style, and that's why I would not say you should never do active or traditional and always do quantitative. So I just think that's too dogmatic for me. I would say that when it comes to traditional active management, which, to be fair, we have the most data. They don't do an S&P index versus active only for quantitative managers.
Mm-hmm.
There's not a large sample of them. So it's a bit unfair. But certainly the data would say that, chances are overwhelming, not 100%, but they're overwhelmingly that your active manager has or will underperform their benchmark.
Have you ever had anybody show up and just say, you know what, I want you to manage it all. I really just want to throw it all into the machine's hands?
Well, no, because it's rare. We do have some of those. The reason being is, they might want to have some exposure to something we don't do. Do you mean their whole investable assets?
Yeah,
Well, that person might want some private debt, or they may want something we don't do.
Sure.
So
fair.
I can't service them in that way, or we can't service them in that way. But yeah, we do have, a lot of cases where we're managing for what we do within that bucket, a very large, if not whole share of wallet.
Yeah, no, I mean, I realize this is a slightly unfair question, but, the point is, and as we're discussing all this, some people really will take to the idea that humans can actually get in the way and cause a detrimental impact on a return, on an investment return, on the research, on the analysis. Now, that's what we're talking about. On the other hand, you might say, well, you know what? I'm going to let the machines run it, especially in the last, say, 12 to 18 months, where people have more and more confidence in how a machine responds, right?
There's no question.
Yeah.
There's no question. It is becoming much, and it has become increasingly easier to proselytize people. But again, part of that is that's dual. Number one is because you can't turn on the radio or read an article or go online without hearing something about AI. And also the results are good. So when you combine those two things, it becomes a much easier message to communicate.
And now for the legalese. The information provided in this podcast is for educational and informational purposes only and does not constitute financial investment or legal advice. Always do your own research and consult with a licensed financial advisor before making any investment decisions. Past performance is not indicative of future results, and all investments carry risk. The views expressed are those of the hosts and the guests and do not necessarily reflect those of any affiliated organizations.